So we just went over the things that go into building a diversified portfolio and becoming a disciplined, tax-savvy investor. Now we're going to discuss common mistakes that investors make throughout their investing careers. One of the biggest mistakes an investor can make is to let their emotions get in the way when making investment decisions. The biggest feature of the stock market is that it's always going to move up and down. On any given trading day, there's basically a 50% chance whether or not the market is going to end the day higher than where it started. Every 4 years on average, the stock market declines more than 20%. Seeing your portfolio fall double digits is unsettling even to the most seasoned investors. Oftentimes, people can't handle watching their wealth deteriorate, and they make an emotional decision to sell their stocks and then move to cash. This is one of the worst things an investor can do because you're locking in investment losses, and then it's hard to find a comfortable time to get back into the market. Whenever we experience a prolonged decline in the stock market, I always try to remember the famous quote from Warren Buffett: "Be fearful when others are greedy, and be greedy when others are fearful." What he is saying here is that when we do have market declines, investors can take advantage by putting more money into the market and buying stocks at lower prices, which should then boost long-term expected returns moving forward. There are some investors out there who have overconfidence bias and think that they can predict or time the market. Oftentimes, investors will pull money out of the market or put more money into the market just based on how they think the market is going to react to a certain event. A recent example of this was the debt ceiling showdown in Washington that occurred at the beginning of this month. On CNBC, leading up to the June 2nd deadline, there were talking heads being interviewed daily, telling people how they should position their portfolios based on all different outcomes of the debt deal. Trying to predict how the market is going to react to certain events is a fool's game that can drive a person insane. I really like this chart on the screen because it shows many of the major events that have happened since 1970, which could have spooked an investor from investing in the stock market. $1 invested in the market being the MSCI World Index, which is essentially the global stock market, in 1970 would be worth nearly $100 today. And that's even with multiple 20% crashes during that same time frame. Making reactionary decisions to try and time the market often does not work out in one's favor. When the stock market rallies higher from a market bottom, it often does so quickly and in short bursts. Missing the best few days of stock market performance can be detrimental to long-term returns. This chart here shows the performance of the S&P 500 index from 1990 through 2022. If you were to be invested during that entire time period, you would have realized a 9.75% annual return. Now, if you look at by just missing the 5 best days of trading during that time frame, the return drops all the way down to 8.23% annually. And that's the difference of about $8,000 over the course of the 32 years. It can certainly pay to stay invested during every market environment. Another common mistake that investors make is holding too much of one individual stock, also known as overconcentration. Many people who work for large, publicly traded companies choose to own the stock of their employer in their own personal portfolios. This can lead to an outsized risk in the portfolio, since individual stocks are much riskier than owning the entire stock market as a whole. One personal example that I'll never forget was when I met with a prospect back in 2016 who worked for GE, or General Electric. He wanted to retire within the next year, so we took a look at his 401k allocation and noticed that 75% of his 401k plan was invested in GE stock. So we asked him why this was, and he simply said, Because it's the best performer in my 401k. Why wouldn't I want to be heavily invested in it? We told them that it would be a prudent strategy to diversify away from GE stock and into more diversified funds so the portfolio wasn't concentrated with the risk of that single stock holding. Now, as you can see from this chart here, GE stock actually peaked in 2016 and then proceeded to collapse by almost 70% over the next 2 years. That prospect never ended up becoming a client, but I do always think back to our meeting and wonder if he did follow through with our recommendation. If not, his retirement would have been in serious jeopardy. Many investors waste time and energy trying to beat the market. More enlightened investors learn to relax and focus on both the things that matter and the things that they can control. They let the markets work for them. Some examples of things that do not matter are hot stock tips, your friend's investment performance, or what the financial media is saying. A few examples of things that are out of your control would be the economy, interest rates, politics, and the overall performance of the stock market. Good investors have learned to not focus on any of these things and instead focus on things that matter and that they are in control of, like your own personal financial goals and aspirations, your own investment decisions, and your own personal savings rate.